Welcome once again to Vida's Real Estate Learning Videos, brought to you by Vida Real Properties and Services, where you can find us at rentandbuyhome.com and vidarealpropertiesandservices.com. So today we're going to be talking about DTI ratios when it comes to qualifying for a loan. Let's get started. Okay, so DTI, that stands for debt to income. And again, there's a lot of abbreviations in real estate. There's another one. So there are two types of ratios. And typically you may hear of them as the front end ratio and the back end ratio. So let's first talk about the front end ratio, which is also your housing ratio. So in short, it's basically the percentage of your total monthly gross income that can be used for your housing payment. Normally, you're talking about 25 to 33% again of your monthly gross income. Okay. On the lower end, we're looking here at conventional loans. As we get to the 33%, we're looking at FHA loans. So lower risk borrowers are on the conventional side, higher risk borrowers for FHA. Again, that's why first-time home buyers typically use FHA loans. So now as an example, let's assume your monthly gross income as a family, let's say it's just a couple, is $4,000. And we're applying for an FHA loan. The underwriting guideline calls for 31%. Okay. So then when we do that calculation, it's going to give us the limit of what your housing payment would be. So let's put them in here in this calculator. $4,000 times 31% equals $1,240. So we come back here. And that's $1,240. Now this $1,240 is your housing payment, which is your principal and interest. That's the mortgage part, plus your escrow, which is your taxes, insurance. You're going to have mortgage insurance if you're using FHA. And depending on what property you're looking at, a condominium or townhome, you may have association fees. So all those cannot exceed $1,240. Now we can move on to the back end. So let's go ahead and clear the board and talk about the back end ratio. Okay, so on the back end ratio, the back end ratio is also the total debt to income. So let's talk about that. Total debt to income now, it's going to be a higher percentage of your total monthly gross income that you can qualify for. Typically, we're looking now at 38% on the lower end to about 43% on the higher end. And again, 48% on the conventional side, and on the upper end, we're looking at FHA. So that's really important. Why you need to have communication with your lender, so you can ask them what are these limits, and you can try and figure out the qualifications yourself. So again, let's go back to that example. You have $4,000. Now we multiply it by 42%, and I'm just picking this number here arbitrarily, but it's a common percentage used for the qualifying. So let's clear the calculator here. So it's $4,000 times 42%. We're looking at $1,680. Okay, so let's put that here on this side. 1680. So what is included in here? So what's included is the housing payment, which we determined previously, okay, also known as your housing from the housing ratio or the front end ratio, but it also includes anything you have on credit. And these are the monthly minimum payments that come up on your credit report. So if you have auto loans, if you have student loans, if you have credit cards, anything that's on credit cannot add more or cannot add up to more than 1680, as we see here. So what happens when it does? So you can see that, remember the difference from the 1680 on the front end ratio, the limit we had was 1240. So if we take the difference between those two, okay, so 1680, and I just want to use a calculator so that we're clear. 1680 minus the 1240 is $440. Okay, so they're letting you have $440 available for your car payments, student loans, credit cards, any bills that show up on your credit report. What happens if you go over by $100? Let's say you have $540 in payments. So what's going to happen is the qualification for the housing payment goes down by $100. So now it's no longer the 1240, it's the 1240 minus the $100 that you exceeded your back-end ratio. So now you're limited to 1140 payment, and again that's the PI, TI, MI, and if you have HOA as well. So that can make a huge difference in how much home you're qualifying for. The other thing to do is get rid of that $100 payment, so basically paying down your debt. And so depending on how much the balance is, how much you have left on the balance on that account, or the type of housing inventory, you need to look at ways to increase that income or reduce the debt to qualify for that, that loan that you're needing. So very important concepts to take with you when you're having this conversation with your lender. And the other last point that I wanted to talk about, what if you have zero or little debt as far as these payments here, your auto, student loans, you don't have any or very little. So what can happen is that your housing ratio can be increased, so that instead of, let's say this example, we're using 31%, now that's going up higher, and maybe that'll be 38% or even more. So that's a conversation to have with your lender as well. You have to be very careful, because yes, right now maybe you don't have these debts, but what about the future, and you do take out a car loan or you take on credit card debt, then these debts or these ratios go up and you still have the same house payment. So then that may affect your bottom line, and if you have no changes in increased income, then you're going to be in trouble. And so you want to be careful with that. So that concludes a little discussion about DTIs. You have just watched Vida's Real Estate Learning video series with the topic of DTI ratios. You can find more about Vida Real Properties and Services at rentandbuyhome.com, vidarealpropertiesandservices.com, or subscribing to our YouTube channel.